if you're looking for a good dividend stock to put in your tax-free savings account, a really good one to consider right now is BCE. It's down around a 10-year low. Stock is down in the dumps, but it's still a really solid business. Not a whole lot of competition. And to top it off, it has a great yield right now. So 8.6% yield right now. So a really, really high. S&P average is around 1.3, 1.4%. So you're getting a ton of money from just buying and holding BCE stock. Now it's down around 2.5% this today because poor telecom outlook. But realistically, this is a top telecom company in Canada, top media company. They're going to be just fine over the long term. There's not a whole lot of competition, so they're pretty much going to dominate for the foreseeable future. And what sweetens the deal is their valuation, because if we look at their statistics again, really low, forward PE of 14.5, price to book 2.5, price to sales 1.7. So it's a really cheap stock. I think the main reason why it's been struggling really is just because interest rates are really high right now. So for people who are looking for dividend income or safer income, they're turning more to bonds and other investments where there's not as much risk as there is with stocks. But once interest rates start to come down, it's really only a matter of time, whether it's this year or next year. Once they start coming down, then you'll see BCE stock starting to rise again, just because of how good of a dividend play it is and because of how strong of a player it is in the industry. Now, if we go look at their chart over the past few years, normally this is a stock that you can see bounces around between $55 and $60. It's pretty well within that range for most of the time. There's been times where it's peaked above that to about 70, but for the most part, if we're going back here to about, let's say 2015, you can see $55. So over the past almost 10 years now, it's been within a range of $55 to, let's say, even $65. It bounces in between that range. So you're not going to get a huge gain from owning this stock in likelihood over the long term. But now, given that how cheap it is right now, we're looking at $45. So the last time it was this low, we're looking at 2013, right? So we're looking at a really incredibly cheap buy, and don't get discouraged by some report from BMO about a poor telecom outlook, because realistically there's not a lot of competition in telecom in Canada. Sadly, that's the truth. I mean, whether you've got Rogers, BCE, Bell, or TELUS, there's not a whole lot to pick from. Whether you hate Bell or you like them as a consumer, there's just not a lot of choice. So regardless of whether you do or not, they're still going to have a pretty sizable share of the market. And at a low valuation, there's a lot of potential for this stock to eventually get back to over $50, over $55, potentially $60. So you could be sitting on a potentially pretty good return, and at the same time, locking in that really high dividend yield. And as you can see from their dividend history, they've been pretty consistent. I mean, the last time they stopped paying a dividend was during the 08-09 financial crisis. So, and that was pretty brief. For the most part, the company's been a really good dividend payer. Right now, you can see their dividend payment just under $1. And so, if we go back to 2010, it's doubled since that time. So not only has the company paid a dividend, it's also increased it, doubled it in less than or around a decade's time, let's say. And the stock's trading at a really low valuation. So if you're a TFSA investor, there's a lot of value in this stock, just because over the years, it may not get you a really big gain, but this is a stock that can generate a lot of dividend income inside of TFSA. It's tax-free. It's a Canadian company, so you don't have to worry about any withholding taxes on that. So that's why this is a stock that, if you're looking to put in your TFSA, should be near at the top of your list, just because it's a dominant player in its industry, regardless of what any sort of short-term reports there are. This company is going to be dominant for a long time, unless the CRTC decides one day to allow foreign competition into Canada. There's nothing really that's going to stop BCE from being a top telecom provider. And right now, things aren't great just because interest rates are high. But as that as those rates come down, you'll see the stock going right back up, back to that 55 to 60 range where it normally has been. So it's a really good value buy. And again, if you're buying for long term, looking for a solid stock to put in your TFSA, there's really not a whole lot that looks better right now than BCE. A solid pick for long term and an amazing yield.